Bitcoin just did something it has never done before. We are historically at the peak of the 4-year cycle. Everyone is screaming to the moon, but my indicators are screaming exit. Look at the RSI on the monthly chart. Look at the ETF inflows drying up this week. The smart money is distributing their coins to retail investors right now. Are you going to be the bag holder? Let us analyze the on-chain data to find the exact top. You are watching this because you feel it. That mixture of adrenaline and anxiety. Your portfolio looks incredible. You are calculating how much you will have if Bitcoin hits $200,000. You are browsing for new cars and houses. But deep down, there is a nagging voice asking, is this it? Is the party over? Most retail investors will lose everything they made in the last 2 years in the next 2 months. That is a statistical fact. They will hold all the way down, convinced that this time is different. Convinced that institutional adoption means the price can only go up. They are wrong. Today, we are not looking at hype. We are looking at the cold, hard mechanics of the market. We are going to look at 3 specific metrics that signaled the top in 2017 and 2021, and exactly what they are saying right now. First, we need to address the elephant in the room, the spot ETFs, BlackRock and Fidelity. The narrative is that because Wall Street is here, the 4-year cycle is dead. They say volatility is gone. They say we are in a super cycle. This is the most dangerous lie in finance. Wall Street did not enter this market to hold hands with you and sing songs. They entered this market to make money. And how do institutions make money? They buy low and they sell into liquidity. You are the liquidity. Let us look at the realized cap hodl waves. This metric tracks how long coins have been sitting in wallets. What we usually see at the bottom of a bear market is long-term holders accumulating. That happened 2 years ago. But look at what is happening now. The 1-week to 1-month bands are spiking vertically. This means coins that were dormant are suddenly moving. Who moves coins that have been held for years? Whales. And where are they moving them? To exchanges. When you see headlines saying Bitcoin ETF spot $500 million worth of Bitcoin today, you think that is bullish. But you have to ask, who sold it to them? If BlackRock is buying, someone is selling. The on-chain data shows that long-term holders, the entities that bought Bitcoin at $16,000, are offloading their bags to the ETF issuers, who are then packaging it up and selling it to your dentist and your taxi driver at $150,000. This is classic distribution. This brings us to the second critical indicator, the MVRV score. This has been the holy grail for identifying tops. It measures the ratio between the market cap and the realized cap. Historically, when this score enters the pink box, usually above a score of 7 or 8, the market is overheated. In 2021, we barely touched it before correcting. Right now, we are accelerating toward that zone at an alarming speed. We are not there yet, but the trajectory is parabolic. This suggests we are in the final euphoric leg of the run. This is the blow-off top phase. In this phase, price action defies logic. We could see Bitcoin jump $10,000 in a single day. This is designed to trigger your FOMO. It is designed to make you take out a loan to buy more. But the MVRV score tells us that the deviation from the fair value price is becoming unsustainable. When the rubber band stretches this far, it does not just relax. It snaps back. Violent and fast. Now, let us talk about the funding rates and open interest. This is where the leverage comes in. Currently, open interest on derivatives exchanges is at an all-time high. Traders are borrowing massive amounts of money to go long. Funding rates are positive and climbing. This means longs are paying shorts just to keep their positions open. When everyone is on the same side of the boat capsizes. Market makers see this liquidity. They know there are billions of dollars in stop-loss orders and liquidation points just below the current price. It is profitable for them to crash the price, wipe out the leverage, and reset the board. We call this a flush. In a bull market, these flushes are buying opportunities. But at the top of a cycle, a flush triggers a cascade. Panic selling sets in. The leverage that pushed the price up becomes the fuel that drives the price down. Let us pivot to the macro environment. because Bitcoin does not exist in a vacuum. The correlation between Bitcoin and global liquidity is undeniable. For the last year, we have enjoyed a liquidity expansion. Central banks paused tightening, and money flowed into risk assets. But look at the bond market. Look at the 10-year Treasury yield. Inflation is proving stickier than the Fed expected. The probability of rates staying higher for longer is increasing. If the stock market corrects because of recession fears or liquidity drying up, Bitcoin acts like a high beta tech stock. It will sell off first, and it will sell off hardest. The narrative that Bitcoin is a hedge against inflation or a safe haven has not been fully stress-tested in a recession. In a liquidity crisis, investors sell what they can, not what they want. And Bitcoin is the easiest asset to sell. It trades 24/7. It is the ATM for the global financial system. So, why is everyone saying we are going to $1 million? Because of the psychology of a bubble. There is a chart called the Wall Street Cheat Sheet. It depicts the psychology of a market cycle. We are currently past the optimism phase and deep into the belief and thrill phase. Next comes euphoria. In the euphoria phase, geniuses are born. You feel like a genius. Your friends ask you for advice. You start calculating how soon you can retire. This is the maximum financial risk point. I want you to look at the Google Trends data for the search term buy crypto. It is spiking. The Coinbase app is #1 on the App Store. When your grandmother asks you how to buy Dogecoin, that is not a buy signal. That is the loudest sell signal you will ever get. The smart money needs a crowd of new buyers to sell into. If everyone is already in, who is left to buy? No one. And when there are no buyers left, gravity takes over. Let us discuss the Pi Cycle Top Indicator. This indicator uses the 111-day moving average and the 350-day moving average times 2. It has historically predicted the cycle top within 3 days. It sounds like voodoo magic, but it is based on mean reversion. Right now, these two lines are converging. They are on a collision course to cross within the next few weeks. Once they cross, history tells us the game is over. If you are waiting for the news to tell you the top is in, you will be too late. The news will be bullish at the exact top. CNBC will be talking about Bitcoin hitting $500,000 on the very day the crash begins. So what does the crash look like? It does not go straight down. It traps you. We will likely see a sharp drop, say 20%. Everyone will shout, buy the dip. The price will recover halfway. You will think, okay, we are safe. Then, the real selling begins. A slow, painful grind downwards that lasts for a year. A crypto winter. Altcoins will lose 90% of their value. Many projects will disappear entirely. If you are holding altcoins hoping for a 100x return right now, you are playing Russian roulette with a fully loaded gun. Let us talk about the Ethereum and altcoin seasonality. Usually, money flows from Bitcoin to Ethereum, and then to mid-caps, and finally to microcaps. We are seeing signs of this rotation now. Bitcoin dominance is beginning to top out and roll over. This is usually the final fireworks display. It is the last chance to exit with dignity. When the garbage coins start pumping 50% in a day, the music is about to stop. You need to understand the concept of opportunity cost. If you hold your bag all the way down to the bottom, you lock up your capital for 4 years. You miss the opportunity to buy real assets at depressed prices during a recession. You miss the mental clarity of sitting on cash. Cash is a position. In a parabolic market, cash is the best hedge you can own. Now, I know what you are thinking. What if I sell now and it goes higher? What if it goes to $300,000? That is the greed speaking. Let us look at the risk to reward ratio. If we are indeed at $150,000 or near it, the upside might be another 20 or 30%. The downside? 80%. Are you willing to risk an 80% loss for a potential 20% gain? That is bad poker. Professional traders do not gamble. They play the probabilities. And the probabilities suggest the clock is striking midnight. Let us debunk the diamond hands mentality. This slogan was invented by people who need you to hold the bag while they exit. There is no honor in holding an asset that is depreciating rapidly. The point of investing is to make profit. Profit is not real until you click the sell button and move it to your bank account. Until then, it is just pixels on a screen. It is a hallucination. So, how do we navigate this? We need a strategy that removes emotion. We need a plan that executes automatically, regardless of how much euphoria or fear you feel. This brings us to the solution. It is time to start scaling out. Do not sell everything at once. That is psychologically impossible. If you sell everything and it goes up 10%, you will panic buy back in at the top. Instead, use a reverse dollar cost averaging strategy. Here is the tactical plan. Divide your holdings. Every time Bitcoin goes up by $5,000 or $10,000, sell 10% of your stack. If we get a blow-off top candle, a massive green spike on huge volume, sell 20%. Move that capital into short-term US Treasuries or a high-yield savings account. Lock in the win. Stop looking at the dollar value of your portfolio. Look at the Satoshi value. Look at what your crypto can buy you in the real world. If your portfolio can pay off your mortgage, pay it off. If it can buy you freedom from debt, buy it. Do not be the person who had the winning lottery ticket but refused to cash it because they wanted a slightly bigger prize. Also, tighten your stop losses. If you are trading, move your stops up aggressively. Trailing stop losses are your best friend in a parabolic market. They ensure that if the trend reverses, you get stopped out with a profit, rather than riding the elevator back down to the ground floor. And for the love of everything financial, stay away from leverage right now. The volatility in the final weeks of a cycle is violent. Exchanges will crash. You will not be able to log in to close your position. The only way to win is to not be overexposed. Finally, prepare your mind for the psychological warfare of the bear market. When the crash happens, the media will tell you crypto is dead. They will say it was a Ponzi scheme. Your friends will laugh at you. If you sold the top, you will be the one laughing. You will have the dry powder to buy back in when there is blood in the streets in 2027. The 4-year cycle is a reflection of human nature. Fear and greed do not change. Technology changes, but humans do not. We are witnessing the peak of human greed right now. Do not get intoxicated by it. Be the sober one at the party. Take your chips off the table. This is not about being a bear. This is about being a realist. The data, the on-chain metrics, the macro environment, and the psychological indicators all align. The risk is heavily skewed to the downside. You have made life-changing money. Now, the hard part is keeping it. Review your portfolio today. Write down your exit prices, valid them, execute them. Do not let greed turn a generational wealth opportunity into a story about what could have been. The market gives, and the market takes. Make sure you take before the market takes it back.